Welcome to the Deep Dive. You've probably heard about global trade, massive cargo ships, and deals worth millions moving across continents. But have you ever stopped to wonder how a seller in one part of the world gets guaranteed payment from a buyer thousands of miles away, often before the goods even arrive? It's the fundamental challenge of international commerce. Today, we're taking a deep dive into the surprisingly elegant solution: documentary credits. Our source material for this deep dive is a fascinating set of Shari'ah standards from an Islamic financial institution, offering a truly unique lens on this cornerstone of global trade finance.
Exactly. Our mission today is really to pull back the curtain on these documentary credits. We want to understand not just their basic mechanics and, their various forms, but crucially explore the very specific Sharia rulings that ensure they remain permissible and ethical within Islamic finance. You're about to get a shortcut, really, to being truly well-informed on this vital yet often overlooked financial instrument.
Okay, let's unpack this right from the top then. For those of us maybe navigating global business or just curious, what exactly are we defining when we talk about a documentary credit? What's its absolute core?
Well, at its simplest, you should think of it as a rock-solid written promise from a bank. We'll call this bank the issuing bank. And this promise is made to a seller who's known technically as the beneficiary, and it's done on behalf of a buyer, the applicant. The bank basically commits to making a payment, could be immediate cash, could be accepting a future bill, or even buying one at a discount, sometimes called negotiation. And this payment is for a specific amount, all within a set time frame.
Okay, a promise from a bank, that sounds secure, but what's the catch? Or the condition?
The crucial condition. And this is what makes it so powerful, but also so precise. The seller must present documents, things like shipping papers, invoices that strictly comply with the instructions the buyer gave to the bank when they applied for the credit. So in essence, it's a bank's conditional payment promise, and it's contingent only on the exact paperwork being right.
Only the paperwork. So it's about the documents, not necessarily the actual cargo itself, at least for the bank's payment decision.
That's exactly it initially.
That feels a bit counterintuitive if you're thinking about, shipping physical goods across the world. Does that ever create a scenario where maybe the documents are perfect, but the actual goods delivered aren't what was expected? How does the system handle that sort of risk?
You've hit on a really fascinating and crucial point there. Yes, the bank's obligation is purely to the documents. Their world, for the purpose of this credit, is on paper. If the documents match the credit's terms exactly, the bank pays. Full stop. Now, the buyer, of course, isn't left without options. They have recourse outside the documentary credit system, usually through the sales contract if the goods themselves aren't compliant. But the bank's duty under the credit is clear and separate. It provides incredible certainty for the seller, knowing if their paperwork is spot on, they will be paid by the bank.
Right, that certainty is obviously key for the seller.
Yeah.
Okay, so we know what it is now, this document-based bank promise. Let's trace its journey. If I'm a buyer or seller wanting to use one of these, what are the actual steps involved? How does it all unfold in practice?
It's often described like a carefully choreographed financial dance. Typically involves 5 distinct stages. First up, you've got the contractual stage. This is actually before any documentary credit even exists. It's the underlying commercial agreement. Often a sales contract for goods, sure, but it could also be, say, a lease or an agency agreement. And crucially, in this contract, the seller specifies that payment must be made via a documentary credit. That agreement kicks the whole thing off.
Okay, so it starts with the deal itself. Makes sense. What's next?
Second is the application stage. The buyer, now obligated by that contract, goes to their bank. They formally request the bank to open the documentary credit. They'll provide all the details, the amount, expiry date, and critically, all the conditions the seller must meet with their documents.
Got it. Buyer applies, then the bank steps in.
Exactly. Stage 3. The issuance and notification stage. The buyer's bank, which we now call the issuing bank, formally creates the documentary credit letter. This is the official promise. They then send this promise to the seller, usually not directly, but through another bank, an intermediary bank, typically in the seller's own country. This is often called the advising bank.
Okay, so the promise travels from the buyer's bank to the seller's bank, or at least a bank near the seller.
Precisely. Then comes stage 4, which is often the most critical bit for the seller, the execution stage. Once the seller ships the goods as agreed, they gather all the required documents, could be bills of lading, invoices, insurance certificates, inspection reports, whatever the credit specifies. They present these documents to the bank, usually the advising bank or another nominated bank. The bank then meticulously examines these documents, and I mean meticulously, against the terms of the credit.
They're checking for that strict compliance you mentioned.
Exactly. If the documents strictly comply with all the instructions and are presented on time, the bank executes the payment as per the credit terms. Could be immediate, could be later. It's only after the bank accepts the documents and agrees to pay that the buyer typically gets hold of these documents. And those documents are essentially their key to claiming the goods when they arrive at the port.
So the documents unlock the goods for the buyer after the bank is satisfied. What happens if the documents aren't compliant? If there's a mistake?
Good question. If there are discrepancies, the bank has the right to refuse the documents and therefore refuse payment under the credit. However, in practice, sometimes the parties might agree to accept minor discrepancies, perhaps with the buyer's approval, or they might try to amend the documents or the credit terms if possible. But the bank's initial right is to refuse non-compliant documents.
Okay, that makes sense. A lot hinges on getting that paperwork perfect.
Yeah.
What's the final stage?
The fifth and final stage is usually interbank coverage. If multiple banks were involved, like the issuing bank and an advising or confirming bank, this is where they settle the financial accounts between themselves. They transfer funds based on pre-agreed international rules and relationships.
Right, squaring things up behind the scenes. So it's quite a process. Like you said, a dance where one misstep on the paperwork could mean the music stops and the payment doesn't happen, at least not smoothly. It sounds like the devil really is in the details, particularly for the seller. We've seen the basic structure and how it moves, but you mentioned variations earlier. Are there different flavors of these things? What kinds of documentary credits exist?
Oh, absolutely. The basic framework is there, but the source details quite a few types, each designed for different commercial needs and risk appetites. One key way they differ is by the strength of the bank's commitment. This is obviously crucial for sellers. You have the revocable credit. Now, as the name suggests, this type can be amended or even canceled by the issuing bank at any time without needing the seller's consent.
Ooh, that sounds risky for the seller. Are they common?
Not really, for precisely that reason. They offer very little security, so you don't see them much in serious international trade. Far more common, and really the standard, is the irrevocable credit. This is the opposite. Once issued, it cannot be changed or canceled without the agreement of all the key parties involved, typically the issuing bank, the seller beneficiary, and sometimes a confirming bank if there is one.
That sounds much better from the seller's perspective. A solid promise.
Definitely. It provides a much higher level of security. But beyond revocable and irrevocable, there are other interesting types mentioned. There's the transferable credit. This is quite clever. It allows the original seller, the first beneficiary, to request the bank to make the credit available either fully or partially to another party, maybe their own supplier.
So they can pass on the benefit of the credit.
Exactly.
Yeah.
Helps facilitate supply chains. Then there's the back-to-back credit. This is a bit more complex. It's essentially where one documentary credit is issued based on the security of another incoming credit, often used by traders or middlemen who are buying and selling goods without handling them directly.
Right, using one credit to secure another.
And for ongoing business, you might see a revolving or renewable credit. This is set up for recurring transactions. It allows the seller to repeatedly draw on the credit, presenting documents for new shipments or operations up to a certain limit within the credit's overall value and validity period. Streamlines things if you have regular shipments.
That makes sense for long-term relationships.
Then there's one the source highlights is particularly interesting, the red clause, or advance payment credit. Now, this one is fascinating because the bank is authorized under specific conditions to pay a percentage of the credit's value to the seller before the seller even presents the required shipping document.
Really? In advance before shipping? How does that work?
Yeah. Well, it's usually based on the seller providing some kind of undertaking or promise to ship the goods and eventually present compliant documents. They also promise to repay the advance if they ultimately fail to do so. It's a huge help for sellers who need upfront cash, maybe to finance production. But it does shift some risk. It's called red clause, apparently, because historically, these clauses authorizing the advance were written in red ink.
Red ink. A literal red flag for the risk, maybe. Interesting. Any others?
Yes, a couple more worth noting. The standby guarantee credit, sometimes called just a standby letter of credit or SBLC.
Yeah.
This one functions much more like a traditional bank guarantee. Payment isn't triggered by shipping documents usually. Instead, it's triggered if the applicant fails to perform some obligation, like if a contractor defaults on a project. The beneficiary can then draw on the credit.
So it's more of a safety net for non-performance rather than payment for goods?
Often, yes, it guarantees performance or payment obligations. And finally, credits are often distinguished by when the payment actually occurs after compliant documents are presented. You have a site credit, where a payment is made essentially immediately at site upon presentation of good documents, then a deferred payment credit, where the bank agrees to pay at a specific future date after presentation, like 90 days after site, and an acceptance credit, where the seller usually attaches a bill of exchange or a draft to the documents. The bank accepts this draft, promising to pay it at maturity again at a later date. The seller might then be able to sell this accepted draft to get funds earlier, though that raises other issues we'll touch on.
Wow, okay. So quite a diverse toolkit available, depending on the deal's needs, from simple irrevocable site credits to these more complex red clause or standby types. But cutting across all these variations, what are the fundamental principles, the bedrock characteristics that define all documentary credits and make them function effectively in global trade?
That's a great question. Several key characteristics really stand out and are crucial to grasp. First, and we've touched on this, but it's paramount, is document centricity. The entire system revolves solely around the documents presented. Banks deal in documents, not in goods. Their obligation is triggered by compliant paperwork without regard to the actual physical goods or the underlying contract's performance, at least for the purpose of paying under the credit.
Right. The bank's world is paper.
Precisely. If the documents match the credit and are presented on time, the bank is obliged to perform its undertaking. That's the core principle. Second is something important for the buyer to remember: the buyer's persistent obligation. Just because the buyer arranges for a bank to issue a credit, it doesn't mean their own payment obligation under the sales contract is completely finalized. They remain ultimately liable until the bank actually pays the seller based on compliant documents. For instance, if the credit expires before the seller manages to present the documents, the seller can still, generally, go back to the buyer directly and demand payment for the goods based on the original sales contract.
So the credit is the method of payment, but the underlying obligation remains with the buyer until payment happens.
Exactly. And crucially, the source notes that the expiry of the credit itself does not automatically kill the underlying sales contract between buyer and seller.
Okay, that's a key legal point. What else?
Third, and this is the flip side providing immense security to the seller, is the bank's binding obligation. Assuming the credit is irrevocable, the issuing bank must pay the seller if compliant documents are presented. Their promise is binding. There are only very, very narrow exceptions recognized internationally. The main ones are if the bank has positive knowledge of outright fraud or forgery in the documents presented, or perhaps if a court has issued a specific ruling preventing payment, maybe invalidating the original sales contract itself. But barring those extreme cases, the bank's obligation to pay upon seeing compliant documents is nearly absolute.
So it's a very strong promise, difficult for the bank to back out of.
Extremely strong. That's why they're so valuable in trade. And finally, a fourth characteristic is the role of governing rules. These transactions don't just operate in a legal vacuum, they almost always operate under internationally accepted standards. The most famous is the Uniform Customs and Practice for Documentary Credits, published by the International Chamber of Commerce. The current version is known as UCP 600. Often, the credit document itself will explicitly state that it's subject to the UCP. There are also related standards like International Commercial Terms or Incoterms, defining shipping responsibilities, which are often referenced. These rules provide a standardized, globally understood language and framework for how banks handle these credits, which builds trust and efficiency.
Right, having those standard rules like UCP 600 means everyone, banks in different countries, buyers, sellers, they're all playing by the same rule book, more or less.
Exactly. It reduces misunderstandings and disputes.
Okay, this paints a clear picture of a well-oiled, document-focused machine designed for efficiency and risk management in trade. But now, let's bring in the specific lens from our source material, the Shari'ah standards. For an Islamic financial institution, simply adopting a conventional tool like this isn't enough, right? There must be specific considerations. What makes a documentary credit permissible or halal in this context? What are the key Shari'ah principles at play?
That's absolutely the core question from our source's perspective. The fundamental permissibility, or jawaz, of documentary credits in Sharia actually stems from Hitler understood, or you could say deconstructed through the lens of underlying Islamic contracts. They're generally viewed as being a combination or compound of already permissible contracts. Primarily, wakala, which is the Islamic contract of agency. The bank acts as an agent for the buyer, applicant, in opening the credit and examining documents, and maybe for the seller in receiving payment. And also kafala, which is the Islamic concept of guarantee or surety. The bank's promise to pay the seller is seen as a form of guarantee on behalf of the buyer.
So, because it can be broken down into permissible components like agency and guarantee, the overall structure is acceptable.
Broadly, yes. Based on this understanding, the source confirms that Islamic financial institutions are allowed to engage in documentary credits. They can open them for clients, issue them, confirm them if asked by another bank, participate in them, and mediate them, whether they're acting for clients or even on their own account, perhaps when importing goods for themselves.
Okay, so fundamentally permissible.
hmm
But Islamic finance always has specific conditions and prohibitions, especially around interest or riba. Where do the red lines appear for documentary credits?
Absolutely, critical red lines exist. The source is very clear. An Islamic institution cannot deal with documentary credits if 1. They relate to goods or services that are themselves religiously forbidden or haram. Think alcohol, pork products, conventional gambling services, etc. 2. They cannot be involved if the underlying contract itself, the sales contract, for example, is considered void or corrupt under Sharia rules due to prohibited conditions within it, maybe excessive uncertainty or gambling-like elements.
So the underlying business has to be halal too.
Precisely. And third, and this is the big one, they cannot involve any usurious dealings, known as riba. This is crucial. It means no explicit interest charges, of course. But it also prohibits implicit riba. For example, charging extra fees specifically for delaying a payment, which effectively turns it into an interest charge. Or, as we touched on briefly before, engaging in what's called discounting deferred bills. This means buying a debt or a promise of future payment, like an accepted bill of exchange under an acceptance credit, for less than its face value today. This is generally prohibited as it's seen as trading debt for non-equal value, a form of riba.
Right, that prohibition on discounting debt seems like a major difference from conventional practice.
It is, and it flows from the broader principle that money itself shouldn't be treated as a commodity to be bought and sold at a profit.
You also mentioned the underlying contract needing to be Sharia compliant. Can you give us a practical example of how that plays out, maybe with a specific Islamic finance structure?
Yes, that's a key point in the source. Let's take murabaha, which is a very common Islamic finance structure, essentially a cost-plus-profit sale. If an Islamic institution is financing an import for a client using murabaha principles, facilitated through a documentary credit, the rules are strict. The Islamic institution must actually become the real buyer of the goods from the overseas seller first. They use the documentary credit perhaps to pay that seller. They take ownership and possession, even if constructively or momentarily. Then they sell the goods onward to their client, the original applicant, at the agreed cost plus profit price. They cannot simply act as a financier, providing funds via the credit and charging a markup without ever truly owning the goods. That would risk being seen as a disguised loan with interest, not a genuine trade transaction.
So the bank has to actually buy and sell the goods in that Mirabas scenario, not just finance them. That's a fundamental operational
A
difference.
fundamental difference, yes. It ensures the transaction is rooted in real assets and trade, not just money lending.
Okay, that makes perfect sense within the framework. Now, banks obviously don't provide these complex services for free. How does an Islamic institution charge fees for handling documentary credits, especially given the sensitivity around riba and the idea of guarantees?
This is a really crucial area, and the source lays out clear guidelines. Islamic institutions are permitted to charge fees, but these fees must be for specific things. They can charge for the actual costs they incur in processing the transaction, communication costs, administrative expenses, etc. And importantly, they can charge fees for the services they provide while acting as an agent, wakala, things like document examination, advising the credit, processing payments. These fees can be a fixed amount, or they can be a percentage of the credit's value, reflecting the work involved and the expertise required.
Okay, so fees for actual work done, actual services rendered. That seems reasonable. What about the guarantee element?
This is where the key distinction lies. The source emphasizes a fundamental Sharia principle. No additional fee can be charged specifically for the guarantee kafala aspect of the documentary credit. Why? Because in Islamic finance, providing a guarantee is generally considered a benevolent act, akin to offering an interest-free loan if the guarantee is called upon. Charging a fee for the promise to guarantee is seen as potentially generating profit from a commitment to lend, which edges too close to riba.
So the bank's overall fee structure must reflect the agency services and costs, but not a separate charge explicitly labeled guarantee fee.
Exactly. The fees must be justifiable based on the services provided and costs incurred, and structured carefully to ensure they don't inadvertently become a form of interest or a charge for the pure guarantee.
That's a subtle but vital distinction. What about security or collateral? Can the bank protect itself if the buyer doesn't pay them back after they've paid the seller?
Yes, absolutely. Islamic institutions can, and usually do, take security or collateral from the applicant, the buyer, when opening a documentary credit. However, the types of collateral must also be Sharia permissible. Acceptable forms include things like cash margins, guarantees from acceptable third parties, pledges of legitimate financial papers like shares in halal companies, mortgages over real estate, or even, as a practical measure, the bank retaining the shipping documents obtained under the credit until the applicant reimburses them.
So holding the documents themselves acts as security. What's not allowed is collateral.
The source specifically forbids taking collateral that is itself haram. This would include things like conventional interest-bearing bonds or shares in companies whose primary business involves forbidden activities like alcohol production or conventional banking dealing in interest.
Right, the collateral itself must be clean.
Precisely. And there's an interesting detail mentioned regarding cash collateral. If the applicant provides a cash margin as security, the institution and the applicant can agree to invest that cash. But it must be done based on a permissible Islamic investment contract, like mudaraba, profit-sharing partnership, or potentially wakala by al-istithmar, agency for investment. This allows the cash collateral to potentially earn a halal return for the parties involved, rather than just sitting idle while still serving its primary purpose as security.
That's quite innovative, making the collateral itself productive within Sharia rules.
Yeah.
Okay, we've covered permissible fees and collateral. Let's get really specific now. Beyond the general principles of avoiding riba and haram goods, are there any other concrete actions or types of transactions related to documentary credits that the source explicitly flags as forbidden for Islamic institutions?
Yes, the source does highlight several specific practices that are strictly prohibited to ensure full Sharia compliance. First, and we've touched upon this, but it's worth emphasizing again, no discounting or negotiation below face value. Islamic institutions are not allowed to purchase accepted bills of exchange from acceptance credits or deferred payment undertakings from deferred payment credits from the seller for less than their full face value before maturity. This practice, common in conventional banking, where a bank buys a $100 future payment for, say, $98 today, is considered a forbidden sale of debt, Beilstein, in Islamic finance, as it involves exchanging money for money of a different amount across time.
So the seller holding a deferred payment credit can't just sell that promise to the Islamic bank for quick cash at a discount.
Correct. The Islamic bank also cannot mediate such discounting transactions for others. They can collect the payment at face value on maturity as an agent, but not buy the debt at a discount.
Okay, that's a major operational constraint compared to conventional trade finance. What else?
Second, a very important principle. Sharia overrides international norms when in conflict. The source states that if a documentary credit issued or handled by an Islamic institution makes reference to international rules like the UCP, then any articles or provisions within those rules that allow for interest-based dealings, like charging interest on late payments between banks or other practices forbidden by Sharia, must be disregarded or replaced with Sharia-compliant alternatives in the context of that transaction.
So the Islamic bank effectively has to carve out exceptions or apply overrides to standard international rules if they clash with Sharia.
Exactly. It means Islamic finance actively interprets and applies these global standards through its own ethical filter, ensuring its principles take precedence.
That shows a real commitment to applying the principles rigorously. Any other specific prohibitions?
Yes. The third one relates to dealings between banks. Interbank relations must be riba-free. All financial settlements, reimbursements, and coverage operations between the Islamic institution and any other banks involved in the documentary credit chain, like issuing, advising, or confirming banks must be meticulously arranged to avoid both paying and receiving any usurious interest. This can sometimes require careful structuring of accounts and settlement procedures, especially when dealing with conventional banks that operate on an interest basis. The goal is to ensure the Islamic institution's participation remains completely free from riba throughout the entire interbank process.
Right, ensuring the entire chain is clean, not just the transaction with the client. That seems comprehensive. So, wrapping this all up, you've now had a really comprehensive exploration, a true deep dive into the world of documentary credits, viewed specifically through this insightful Sharia-compliant lens. What might initially seem like just a standard, maybe even dry, financial tool for trade actually reveals layers of intricate processes, very crucial definitions, and these highly specific rulings designed to ensure global commerce can happen ethically and permissibly within the Islamic framework.
Indeed. And I think understanding these standards really highlights how Islamic financial institutions aren't just, putting an Islamic label on conventional products. They are meticulously adapting, sometimes fundamentally re-engineering, these complex financial instruments to ensure genuine adherence to core principles like avoiding interest, uncertainty, and forbidden industries, while promoting transparency, fairness, and a focus on real economic activity.
It's genuinely fascinating to see how those specific Sharia requirements, things we discuss, like how fees are structured, the prohibition on discounting debt, the need for the bank to sometimes take actual ownership in murabaha, the overriding of conflicting international rules, how all these actively shape the practicalities of global trade finance for these institutions and their clients.
It really does, and it perhaps raises a broader question for you, our listeners, to consider. Could this meticulous framework developed for Sharia-compliant documentary credits, with its inherent emphasis on transparency, service-based fees rather than interest, clear risk-sharing principles in some structures, and a fundamental aversion to trading debt, could aspects of this framework perhaps inspire or influence the wider global financial community? Could it offer pathways towards developing more ethically grounded, more transparent, and perhaps even more stable solutions for handling complex international transactions for everyone? Something to think about.
That's a powerful closing thought. Thank you for joining us on this deep dive into the world of documentary credits and Sharia compliance. Until next time, keep digging, keep questioning, and keep getting well informed.